Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Live from New York and Seattle, it's Talking Real Money. Hi, I'm Don McDonald, live in New York. Tom is live in Seattle.
And in Seattle. That's correct. Thank you, Don. I appreciate that.
Well,
yes, you are in New York for the
right?
discussion of the inverted yield curve, so we'll wait on the live news conference for that later. That's coming soon, so we'll be there for that, covering it. Yeah.
And,
do they do that over the city,
and
or
Tom
do they
is
do
ready.
that? Where do they do the inverted yield curve? Is that where exactly do you see that there?
I think they stretch it over the East River. I think it's like it'll be right out there. Right
Makes
out over
sense.
East River.
Makes good
So
sense.
invert their yield curve. Hi, welcome to the show. Tom has just pulled his intravenous line of 5-hour energy, and he's ready to go.
Yeah, I am ready to go. I feel good today.
Dancing in this.
I know. I feel good.
And our phone number, 855-935-TALK, 855-935-8255. Give us a call. Again, we're bribing you with books, Financial Physics, the new version, and we're getting a fresh new batch in, all of which will be actually signed by me and sent to you. So please allow 4 to 6 weeks for delivery.
No shipping charges apply.
No shipping.
Yeah,
no nothing. You just call, you ask a question, but you see, here's the deal. You got to call the live show and ask a question on the live show, because occasionally people will call it later and go, well, did I get the book? No. You only get it when you call during the live show.
Not the weekday thing where you'll take people's deal. Okay.
Some rules do apply.
Indeed.
Not
so,
many.
and get in early be my other suggestion, because the second hour always busier than the first.
Always,
Yeah.
for some strange reason. But that's been the case with talk radio for as long as I've been doing talk radio. It's like, I did have something. It's a matter. Do you have any questions? No one raises their hand. Then somebody asks a question. Everybody goes, oh, you mean we can ask a question? Oh, I thought you meant a question.
Yeah.
But a real question, I can do that. 855-935-TALK. We have a little delay on this, don't we?
We do.
On the I'll have to dial back in on my fancy schmancy connector at the break. But anyway, right now, what we want to do is talk about the things that are most important to you about money, how you invest, where you put it, how you save it, how you can best grow it, how you can derive income from it, how you can deal with a lot of the problems along the way, how you deal with the people, how you deal with the rounds investing. And some of the confusion surrounding investing is about these magical yields, these incredible special returns that endowments get, or pension funds get, or really super rich people. They get these high yielding investments that can pay. How do they do that?
Well, they do it because they're special, because they get to invest in things that you and I don't get to do, and they oftentimes get to use leverage, and they get to be kind of on the, I hate to use expression, inside, but they get the secrets of what's going on in Silicon Valley or wherever it is before it does. Yes.
You make that sound like these things actually always exist.
No,
See, you actually convinced me that those things exist. Now, you got to clear this up. They're not really there.
That's the point. And by the way, if you want confirmation of it again, you could watch the recent HBO documentary on Elizabeth Holmes this week, where there were very special
Theranos.
people that got in and found out that it really wasn't that special after all. But the point of the matter is, should you be putting your money, or should anybody be putting their money in something special like private
equity?
Right, yeah.
Yeah, that's all the rage. Private equity is all the rage. And right now, there's been some news recently. A couple of people have talked to me about it, about CalPERS, the California Pension Plan, not happy with their regular people investments. They want to get more. They want to put more money into these special private equity style investments that are yielding about 8 or 9%.
Yeah.
But They do it not because they're getting special investments, but because we're in a rising market for these kinds of investments, and they're using leverage to enhance the yields. And that is an important factor to bear in mind. We leverage magnifies yields. It makes them bigger. If you buy a house for $200,000 and it goes up $10,000, you just made, or if you put $10,000 down,
yep.
You have a 90% mortgage and it goes up to $210,000, you just doubled your investment. You got a 100% return.
That's how good leverage can be on the upside. But let's talk when we come back about what it can mean on the other side, the downside.
There's always a flip side, and that's the part you need to be aware of before you get excited about some of these special opportunities. 855-935-TALK is our phone number, 855-935-8255. Call Talking Real Money. We'll help you out with your money.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Yeah, I'm Don. I'm in New York, so the quality may not be as good as when I'm on a better connection. I'm at a hotel in New York, so connected via T-Mobile.
Yeah, you sound fine.
Just
you sound good. You always sound good.
T-Mobile.
You sound good.
Thanks. Oh, that's so nice. We were talking before the break about these extra special investments, these things that the rich people can get into, that the pension funds.
Well, they have $28 billion.
endowments.
$28 billion with a B at CalPERS. That's a lot of money.
That's a fair amount of change. Yeah, that's pretty substantial. But some of the investments that they look into, things like private equity, they use leverage to enhance their returns, just like you do when you buy a home. You think, oh, I put $10,000 down. I bought a $200,000 house. It went up 5%, but my money doubled. That's the power of leverage. But what leverage giveth, leverage taketh.
Yeah.
On the downside, and this is a true story. Phoenix, Arizona, 2007.
Yeah, we were there.
You buy a house for $200,000. You put your $10,000, not 10%, 5% down. You carry a note at a ridiculous rate, or it was a little higher then. Yeah. And then comes 2008, and instantly your property is now worth $190,000. You've lost every penny of your initial investment if you need to get out. Then the next month it's down again. Then the next month it's down again. Pretty soon, this actually happened. It's down below $150,000. You have now lost not just your entire principal, but an additional $40,000 that in many states you owe. You didn't just lose everything you invested. You owe money over and above what you invested because of leverage.
What you're saying is you can't just walk away, hand them the keys, and not expect to pay what's owed on
in
these
some
properties.
Places you can.
True. That's right.
In some places you can't. There are deficiency judgments.
Yeah, non-recourse state. Yeah, so I mean this, and so this is something for people to remember. By the way, if you go read more into all these things, what CalPERS is hoping is that they're going to make somewhere around 9% on private equity and around 7% in capital markets in the boring, mutual. But here's the thing I find more fascinating. There's people that say, okay, show us. The investment advisory firm Preston McSwain said, okay, we'll put up $1,000 that over the next 15 year basket of these 10 largest private equity funds won't outperform just the Vanguard Extended Market Fund. And I would put my bet on the Vanguard Extended Market Fund. I would.
I would too, because and they said with leverage.
With leverage.
That if you use leverage on the Vanguard Fund, the Vanguard Extended Market will kick it with leverage.
Yeah, so go ahead. Let's see it.
Although, in a down market, you could lose all of your investment. And that's one of our biggest points here on this show, is that it is no longer an investment when you can lose everything.
Yeah.
You shouldn't be in anything where you can lose every penny you put into it. That's not smart.
Yeah, it's
the opposite of smart.
That's why we suggest things like index mutual funds or exchange traded funds that hold thousands of stocks and bonds. if that goes to zero, we've got a much bigger problem.
Absolutely. 855-935-TALK is our number, 855-935-8255. It's a free copy of Financial Physics Saturday. Too bad it's not Friday. That would have been very, very alliterative.
Really would have worked.
Darn it. 855-935-TALK's the number. And Maria, you're up. Welcome to Talking Real Money.
Hello.
Hello.
I have a very simple question. What it is that I've been faced with a predicament. I have a 401k by my company that I was with. And now I have been informed that I need to release that, transfer that money to something else, and I just don't know what, because I also have a Roth IRA that I have with my bank account, and so I'm just thinking, can I take that 401k and transfer it over?
Well, so have you moved to a new company?
No, I haven't.
Okay, so
and that's the thing.
All right, that's okay. And by the way, companies are allowed at certain amounts in those accounts to say, our rules say you got to move the money out. They don't want to take care of. That's fine. So
that's fine. That's not a big deal.
Not a big deal at all. So you could simply, and this wouldn't take very long, you could go to Vanguard.com and open an IRA.
Yeah,
that'd be one thing.
I'm a little concerned, though, Maria, because you have your Roth IRA at the bank. What?
Because what it is that it was one of those foolish things I did when I was in my early 20s, and I just opened it up, and so I've been using it as my rainy day fund. I just throw, the coins that you see in your pocket, I just throw it in there, so to speak.
Okay. So you're not taking money out of this Roth IRA. When you said rainy day fund, you scared me there for a minute.
No. That money that you always drop into the jar and everything. Well, that money
Right.
I always this is when it just first opened up. When it just first started. It was
How old are you, Maria?
I am 50.
Yeah, I would go to Vanguard,
I would go with your
open
advice,
an individual retirement account there. I would and we give you a two
take
funds.
the risk quiz.
You could take the risk quiz, which is apparently working this weekend. It took the weekend off last weekend.
It is. I fixed it.
I make a software joke here, but I won't because it's bad taste. But so the point of the matter is, find out what your risk tolerance is, and then balance. I think at Vanguard between the two funds we give you, the VT WAX. That's a globally diversified stock portfolio of about 8,800 stocks, and that's the stock part. And then the Vanguard Total Bond Market Fund, which now, Don, I get these tickers in my head. I just forget the ticker. Anyway, I'll pull it up here for you in a second. I got so many of these things. The Vanguard Total Bond
Index.
See, I'm a little iffy on the market right now because of the way it's been going.
You should always be iffy on the market because that's the reality. VBMFX. That's why you have bonds. Bonds are the stability. So at 50, if you just said, I want to be somewhere in the middle, you could have 60% of the money in stocks in the stock fund.
Yeah, but hold on.
40 in the bond fund.
Hang on, because she's expressing that thing we got to be careful with. That I'm concerned about the market.
Yeah.
That needs addressing. Because let me just tell you one, you will never, I don't care what kind of feelings you have, what you've read, what you heard on the television or listened to on the radio. There is not a soul who knows that when the market is going to go, if the market's going to go down, well, we know it will eventually,
of course,
but no one knows when. The market goes down roughly 25% of the time. It goes up roughly 75% of the time, which means being in, since you can't tell the future and no one can, being in is a better play than being out.
And then you build this balance between stocks and bonds that I talked about. So the VTWAX is a all stock fund. That's the riskier stuff. And then the Vanguard Total Bond Fund that I just mentioned is the less risk. The bonds, that's the foundation. You balance between those two. That gives you proper asset allocation in that IRA.
But if you play it safe, there's one thing we can guarantee. If you want to play it totally 100% safe, you will never make any money. You just won't. 855-935-TALK, our number.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Really important stuff. Give us a call at 855-935-TALK, 855-935-8255. I'm Don. That's Tom. You're there. Give us a holler, 855-935-8255. And please understand, if you don't understand anything else from this show, please get it through your head that no matter how you feel or what you think or what a, quote, expert says, there is no one on the planet Earth who can predict what the stock market or the bond market or any other market, or for that matter, anything else is going to do in the future.
And by the way, there is no wealth without risk. You correctly point out you need to extend yourself somewhat into riskier things to make money. There is no putting it in the bank and creating enough wealth from that to provide income in retirement. That's another huge trade-off you got to deal with. Sorry.
855-935-TALK's the number, and Cheryl's up next. Welcome to Talking Real Money.
Hey, Cheryl.
Hi.
What's up, Cheryl? Hi.
Oh, well, I'm so delighted to talk to you. Thank you.
Well, that's very nice. We don't get that a lot, so we'll take it.
Yeah,
okay.
Certainly not at home.
Well,
No.
well, I have a very unusual situation, I think. Maybe it's not. I am living with my 93-year-old mom, who's in declining health, as you might expect, in a paid-for mobile home. She has enough money for her monthly needs, and she just got a $300,000 inheritance.
Wow.
And so here we are.
I'm going to stop you there. I would say somebody who's 93, it would be unusual for them to receive a $300,000 inheritance. Yes, that's unusual.
Yeah.
But it's good.
So
No, it's good.
bless my dad's brother for living a long time and caring so much for my mom and other members of his family. He was well off, and it was nice of him to share it when he was alive and now. So that's great, but she's not taking any cruises. She's not buying a Ferrari.
I hope not.
Really,
It's not enough money.
She should drive slowly. I think a Ferrari would be a bad idea. That'd be my take.
Okay, very bad idea. We're completely flummoxed as to what to do with this money. We just really can't afford, to lose any of it. But as you were just speaking of, you've invested in the stock market, of course you're going to lose money.
Let me just, because of her age, Cheryl, of her age, what I would do is, let's just make this very, very simple. You set up a money market account. First, you set up a money market account. You go to bankrate.com. It's a great website. Set up a money market account. There are some earning about 2%, and put about 25% of the money in this money market account. Then, because you want absolute safety, then go get a CD that matures in 1 year, and one that it matures in 2 years, and one in 3 years. That way, she's earning a little bit of money on it. She's got 25% of it. She has $75,000 that she can use this year to improve her lifestyle. Just to improve her lifestyle. To buy, to splurge on a nice meal once in a while. To buy a new dress, or to get an iPad so she can FaceTime with her grandkids, or whatever it might be. And then what you do is, when the 1 year CD comes due, you replenish the money market fund with however much she used, and then you roll that leftover amount back out to another 3 year CD. And just repeat.
At her age.
And make it a discipline.
I like that. Yeah.
Make it a discipline. Then she knows every year she's got $75,000 extra dollars that she can use to not worry about things. If she wants to give a grandkid a nice Christmas present, she can do it. If she wants to, to meet a friend for tea somewhere, you can get her a lift or something to pick her up and take her. You can do a couple of little things, not the big things, but it's those little things that sometimes make your life so much more enjoyable. And she should kind of splurge on herself a little bit while she's still with us. So that's what I do. And then whatever's left over after she passes, she can pass on to her heirs as she sees fit.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
All right, maybe it's not an exciting subject or titillating or newsworthy, but this is some of the most important stuff that anybody can be talking about on the radio if those anybodies are semi-honest or even slightly honest, which I hate to say
not
many are
acting
not.
in self-interest. By the way, but if we want, we could get into the inverted yield curve. We could do the Mueller report. There's a lot of other things.
We could
March
do
Madness.
At some point, I would like to discuss the inverted yield curve because, that's another example of sort of yellow journalism, yellow-green journalism.
It's led to a lot of my problems over the years. I can safely say that. My back still
Inverting
hurts.
your yield?
Oh, God, it's killing me.
Yeah, I got to tell you. 855-935-TALK is my number. 855. It's not Tom's, just mine.
Okay.
855-935-8255.
Then you take it, man.
I'm going to take it.
Right.
I'm taking responsibility for it. 855-935-TALK. Get a free copy of Financial Physics. Ooh, signed by me even, which ups the price by a good 10 to 12 cents if you resell it
Speaking
on
of
Amazon.
leverage.
Yeah.
Buy 1,000
Yeah,
copies
in a bad
of
market,
that.
in a bad market though, that 12 extra 12
Adds
cents
up.
could cost you $1.20. You never know.
Exactly.
855-935-TALK. Give us a call. Loy, you're up next. Get us out of this. Thanks for
Please.
calling.
Hi, I'm calling regarding to my situation. The situation is that my wife and I both work and have an income of $210,000, and what I'm thinking is we contribute to last year we contributed $26,000 in deferred comp. The more I think about it, should we continue contributing to deferred comp? Because by the time we retired, we will be getting a pension from a pension, 70% of our income.
Mm-hmm.
So,
How much of your income?
whoa,
70%? Did you say 70?
Yes, 70.
He'll get a pension that's 70% of his income, which there are very few of those left.
Yeah.
Congratulations on having it. But why would you not want to continue to put the $26,000 in deferred comp? What's the downside of doing that?
I'm thinking that we will never touch that money, and by the time we get to 70, we might have to pay more taxes and also, tax.
What would you do with the money if you weren't putting it into your deferred compensation plan?
Well, focus onto the after tax, which is the Roth, and then whatever money, pay off whatever debt we have.
Okay, no.
Okay, that's making sense.
Yeah. Yes, should you pay the debt off first? Absolutely.
Yes.
Now, that would depend somewhat. Are you talking about like mortgage debt, or are you talking about
a home equity? Basically, we have
a HELOC
in mortgage, and $150,000 in HELOC.
I would go ahead and work on that HELOC, pay that down, sure.
Because that's an is that an adjustable rate HELOC or a fixed?
No, it's a fix. I got a really good deal. It's like 4.25.
Okay, but still.
I'd be tempted not.
You could do some of both. That's okay.
Okay, yeah. Go ahead and fund your Roth, both of your Roth IRAs if you're Roth eligible. But I don't know that you are.
No, you're not at $210,000.
Not at 210.
No. Mm-mm.
Well,
you could do it at work, maybe.
Yeah. So I think we this is gross. So so far I did my taxes this year, and my net income is after all the defer is about 163.
Oh, then you are eligible.
Okay.
So,
Lloyd, but here's the thing. We get this call a lot from people wanting to pay off mortgages. And again, Tom said the HELOC maybe, the mortgage no. But bear in mind that when you're making 4.25%, and if you're invested in portfolios with equities, you are probably making more or at least you
Have.
should over a long period of time, more than 4.25.
Right. So just continue what we're doing?
Well, no, I think I would do a combination, okay? Here's what I would do. I would do the Roths for sure, unquestionably. Number two, I would have a strategy for the HELOC that maybe paid it off over 10, 12 years, whatever it is. Then the other money I probably would still do with the deferred comp. What happens is then at retirement, you have several, you can game the pensions a little bit. You can decide on income from deferred comp or from Roth. It gives you a number of buckets to provide your income in retirement. That's probably the strategy I would employ.
I agree. I think your options will be great if you have that extra deferred comp money. And remember, if at some point down the road you drop into a lower tax bracket, you can also convert a bunch of that over into a Roth vehicle and pay the taxes when you're in a lower bracket. So it gives you a lot of options.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Only because it's massively important. I'm Don McDonald. Over there's Tom Cock. I'm in New York. He's in Seattle. We're all over the place, and we're trying to help you become a better investor, manage your money better, not make a lot of the mistakes that people make, spending too much, trying to get into things that they ought not be in. 855-935-TALK is our phone number. Give us a call, and Thomas is next. Welcome to Talking Real Money.
Hello, Thomas.
Good afternoon.
What can we do for you, sir?
Okay,
Yes.
The question I have, we started listening to you a year ago. Enjoy your show. 12 years ago, we bought a variable annuity. So it's less than 3% of our total investment. How do we ascertain whether to keep or get rid of it now?
Is there any surrender left? I'm assuming that's gone.
Should be.
And I'm sorry, what does surrender mean?
A surrender charge, a fee that they charge you to liquidate the account, to take
Get
all your money out.
Yeah.
I'm
confident it's gone.
10 years.
Okay.
It's Bright
Yeah,
House
10 years.
Financial. I thought it was 10 years, but I'm not 100%.
All right. It'd be
probably about
unusual
right.
for him to go 12. I've seen it, but it's... Anyway, so is this in a tax deferred, like qualified money, like an IRA, or is this in regular old taxable money?
It is regular old taxable money. We actually left the advisor when he tried to put money in our IRA into one. We said no.
Good
move.
Good job, Thomas.
Smart man.
Yeah.
You figured it out. Why would you want to put
We were
something that
we
is
were
tax
just
deferred
select.
and something tax deferred?
Because you get double tax deferral.
Yeah.
That doesn't mean... I'm kidding.
No, you don't.
So
See, he keeps stating things as fact,
I'm trying. No, you don't get.
and
double
you
tax
can't
deferral.
see facetious on the radio.
Thank you for correcting me. I appreciate it. Don't ever put an IRA into an annuity ever. That's a whole separate topic. Here'll be my question. Number one, you'd have to look at the value of the account. So you wouldn't want to just sell everything if you were going to take a tax hit. In other words, you may need to transfer that to another annuity product, and they're out there. TIA has a wonderful one with no surrenders, very, very low fees, like 10 basis point fee, and the underlying assets are in dimensional funds, which we like. So you can do a 1035 exchange rather than cashing it all out. How much money are we talking about?
Less than 200.
Okay.
Less than 200K.
So, so there's some work to be done. There isn't one easy answer, but the point of the matter is you could go to an hopefully you get a good advisor who would tell you, here are your options, not somebody who sells annuities.
Yeah,
by
I was
the
just
way,
going to say,
because-
well, wait, no, the Bright House guys are just, they're just life insurance. Bright House is a spinoff of MetLife.
Mm-hmm.
Right.
And so they're just product pushers. They are not financial advisors. They are not registered investment advisors unless they wear two hats. And even then, the thing is what you're making on that account right now is with the fees and expenses is very likely, and without looking at the policy, I can't tell you for sure, but I'm pretty confident that you're making about 3% less than you would make in comparable investments outside of the annuity. And the tax deferral just isn't worth that kind of bite unless you're in a 30% tax bracket, and even then, and the death benefit is negligible. It's almost meaningless. I would, if this was my money, I would very, very quickly over the course of a few years take the bite. I would get it completely out, move it somewhere else with the tax hit, or move it into a no load variable annuity. Vanguard actually offers no load variable annuities so that you can do an exchange right over to them. But I bet this one's expensive.
And TIA's, by the way, is a little better. The costs are a little lower. But
yeah, they're a little lower, yeah.
Again, my overarching advice here would be to go get some advice from a fee-only fiduciary advisor who is not going to spin you into a new product, as Don correctly points out, because you want to do whatever you can the most carefully around taxation. That would be important to me.
And one of the ways you can find one of those fee-only advisors, go to Talking Real Money. There's a button, there's a link that says, here's a list of advisors in your area. And this is about as big a plug as I'm ever going to give on this show. But we have also recently instituted a system whereby we can set up appointments with our advisors who will talk to you. You look things over without you becoming a client, without any pressure to become a client, in situations just like this where they can look at it and you can send them the stuff. They'll spend up to maybe an hour with you. Anything more than that, you got to hire us. But we want to help everybody make this happen. And we decided that instead of just sending people out there into the wilderness and say, go find yourself an advisor, that you can set up an appointment online with a Vestry advisor. They will not sell you anything. We're on the radio. If they do, call us and say, you lied, you tried to sell it. We don't do that. It just doesn't happen. So go online, set up an appointment with one of our advisors. I promise you they won't try to sell you on becoming a Vestry client. We'd love it if you do. We don't mind if you don't.
And can you do that at TalkingRealMoney.com?
Yeah, you can do it at Talking Real Money.
I thought you could just do it at Vestry.com.
No,
I don't. Okay,
no, I have it everywhere.
They never tell me anything going on around there.
See, right here it says meet with a Vestry fiduciary advisor. Right. Look at that.
All I do is write the checks while everybody else is having fun. That's my job. I have no idea what actually goes on. So good. I think that's good advice. Go get some help would make sense in this case.
Because it gets a little complicated because we have these tax ramifications and then you got to dig into the policy and see. This is anything that's complicated is bad for you.
I agree.
It's my rule. If it's complicated, it's not good.
Keep it simple. Yeah, makes sense. By the way, since you just did a plug, can I do one too?
No, we can only do one plug an hour.
I'm so excited too.
What, do you want to plug your class?
Yeah, forget it then. I won't do it.
That's
fine.
You wanted to plug your class because you thought you would sell 16 seats.
Today.
Which is all the seats there are. There are only 16 seats for the class. And Tom honestly believed he would sell all 16 of his seats today.
And I think
That's
I will.
His
I think I will.
Ridiculously high level of confidence. In fact, I think it's like bloated. This is probably due to that IV earlier of the 5-hour energy.
You want to get the most you can from Social Security. You want to provide retirement income without worrying every day about the stock market.
Or without getting into an annuity.
You need to come to the Science of Retirement Income with yours truly, April 24th. It's at our office. The doors don't lock behind you, though. You can walk right out without doing anything. We'll feed you. And how much is it, by the way? I have no idea.
Okay. It's the cost of lunch.
It's
exactly the cost of lunch.
Much?
$10.
$10. It's 1 hour. You're going to learn a lot.
That's what we pay. Yeah. That's how much we pay for the lunch.
It is.
Because we don't give you a free lunch. You got to pay for your lunch.
All right. So Anyway, that's noon, April 24th. Those tickets will go extremely fast.
Let me go check. Oh, sure they will. Let's go to let's make sure
Maybe
it's working right.
Maybe not all the day. Prove Don wrong.
Let's go.
Get signed up. Make him look bad.
Prove Don wrong.
Exactly.
You're just trying to make Barb feel bad because she didn't sell hers out the first day.
That's a good point.
Yeah, let's see. Oh, there it is. Lunch Ed, the Science of Retirement Investing, April 24th at noon.
Thank you.
At the Vestry Education Center.
Yeah, it's lovely. The food is great. The education is even better.
It's from Panera.
Oh, okay. Well,
it's good.
Yeah,
I like Panera sandwiches, and it's a pick two kind of thing. I think you get a sandwich, or it's like a half and half. It's a sandwich and a salad or something.
People were very happy with the meal they got last week because Barb Devereaux did her class. I know that, so they were okay.
So go get your tickets.
TalkingRealMoney.com. There's the shameless plug.
No more. Oh, there'll be one more plug.
Okay.
We got a commercial break coming up, and there'll be another plug. I'm feeling bad now. 855-935-TALK is the number if you want a copy of the book, Financial Physics, signed by some guy named Don McDonald who wrote it. You just call the show and ask a question during the course of the live program, which is Saturday from 3 to 5 Pacific.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Oh, yeah, I think I forgot to give the phone number before the break. 855-935-TALK. 855-935-8255. And make Tom feel better. Go get tickets to his class. You'll enjoy the class, and you will enjoy the lunch. And I just noticed there's also a cookie with that. A freshly baked cookie. Get your tickets now at TalkingRealMoney.com. TalkingRealMoney.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?